everyone. Welcome to the market update this month. I like to bring you the latest San Antonio market and the trends from the previous month to keep you informed and also ahead of the curve. I'm joined by my trusted lending partner, Jen Bailey, with Legacy Mutual Mortgage, so you can get a clear, up-to-date insight on real estate and the lending part of it and make great, confident decisions. I'm the broker owner of MStagersRealtyPartners and the team leader of the Missy Stagers team, and let's take off with this report. In January's market update from San Antonio and the surrounding region, we're going to reflect upon December's market ending December of 2025. Overview has more options plus steady pricing, a healthier, more balanced market. That's what they say. That's when we're in the 6 months approximately market. Inventory is up. Homes are taking longer to sell and buyers have more room to negotiate while values are generally holding in the core single family segment if you price it right or once you get it priced right. Key numbers at a glance. Single family sales. Total sales, 2,854 in December. That was up 8% over the previous December. Average price, $375,539, which was a 2% increase. Median price is $309,990, which is a 2% decrease. Price per square foot, $171, which is 3% less again. And 92 days on market, which is up 15%. Closed to original list price is at 91%, showing that there's definitely negotiation going on. Months of inventory is actually down a little at 5.25%. Active listings are at 14,441 and new listings were down 14% at 2,753. Pending listings were down at 1,874. What does all this mean? Homes are still selling. Buyers are taking lots more time and being very selective. So condition and pricing are very important. The inventory is giving buyers breathing room. And just so you know, we've got the most amount of listings we've had on the market since 2013. Active listings rose year over year, 8%, and months of inventory sitting at that 5.25 level actually has been pretty much that way all year, which signifies that balanced market. The market is more price sensitive, meaning they're counting their dollars. Median single family price is slightly lower. And new homes plays into all of this. New homes actually even plays into an uptick in sales. And the price per square foot about 2 years ago was at $189, and again we're at $171. So what's important to know? Time to sell is longer. You gotta plan for it. In addition to that, to be honest, if you're going from list price to sold price at a 91.2%, we typically only come off 3%. It means you weren't priced right to start with. So it's very important for sellers to price right. The market will buy something that looks great and is priced right. Let's talk a little bit about rentals. They've been soft too, unfortunately, because for the people that couldn't sell, they put it up for rent. And in some areas, there is an oversupply of rent. So active rental listings are up 20% from year over year. What's the takeaway for the rental market? Tenants have choices. You better put it on the rental market aggressively, and you might want to look at options of 1 month's free rent, other ways you can pull in a tenant. What's the luxury snapshot? Let's talk about that. The Institute for Luxury Home Marketing shows that single-family luxury market is becoming somewhat of a buyer's market too. With 9% sales ratio, their metric for the market speed, and a median sales price of $775,000, and that was in November of 2025 reporting. Homes sold for a median of 97.29% from sales price to list price. So luxury's pricing their homes much better. And I can tell you, if a luxury is priced right now, it sells much quicker than regular resale. The upper price points do have leverage though. I am seeing negotiations, but not as much as what I'm seeing in the other markets. So let's talk about how does San Antonio compare statewide. Total sales statewide was 26,675, up 5%. The Texas median price was 335,000, which is down 2.1%. Bexar County, its median price range is 294. This means for our area, the general pattern is similar, actually, statewide. Sales activity is holding. Pricing is steady to soft depending upon the segment and again, location, location, location. What I'd tell buyers and sellers this month, if you're buying, you got great choice, you've got some negotiation and rates are down, get out there and look for a property. If you're a seller, position yourself to be the choice. That's what's really important for you. So with that, that's a wrap for our market report. And I'm going to have Jen Bailey talk to you now so she can actually tell you some great news in the lending department instead of our story of being in a balanced market and it takes longer to sell. So with that, let's listen to Jen. And most importantly, if you're thinking about refinancing, you might want to give her a call now too. Take it away, Jen.
Hi, I'm Jen Bailey with the Unity Group of Legacy Mutual Mortgage, and let's talk about mortgage rates on the market right now. So mortgage rates this year have been basically shaped by a combination of inflation trends, the Fed Reserve policy, economic growth, global uncertainty, a lot of factors. Now, while inflation has continued to cool compared to the highs of the early 2020s, it hasn't fallen far enough for the Fed to aggressively cut rates. And as a result, the Fed has stayed cautious, signaling patience rather than rapid easing, and that's kept mortgage rates from dropping quickly, but they have dropped. Another big factor is the strength of the US economy. Typically, when the economy is doing well, mortgage rates don't respond as well. Employment has remained relatively solid, consumer spending has held up, and the resilience makes the Fed less urgent about rate cuts. So strong data tends to keep pressure on rates even when inflation is trending in the right direction. We've also seen rates react to bond market improvement, especially the 10-year Treasury. Mortgage rates closely follow bond yields, and anytime investors worry about inflation reaccelerating, government debt levels, or global instability, yields will rise and mortgage rates usually follow. So housing supply also has played a role. Inventory remains tight in many markets, which has helped support home prices and demand. And that demand puts less pressure on lenders to aggressively lower interest rates, even when buyers are rate sensitive. The big takeaway for 2026 is that rates are no longer in crisis mode, thank goodness, but they're also not in a straight line drop either. We're more in a normal data-driven environment where rates move up and down based on economic reports, not based on headlines as much. The most recent news, Fed prosecutors have opened a criminal investigation into the Fed Reserve Chair Jerome Powell over testimony he gave in June regarding the renovations to the Fed Reserve buildings. Powell responded in a video saying he believed the investigation was opened because of Trump's anger towards the Fed's refusal to cut interest rates as quickly or as much as he wanted. So we'll see how all that shakes out, but that does typically impact things. So in reports that are coming out soon that can move rates, the PPI, retail sales, existing home sales, and initial jobless claims, reports that come out every single month. So we'll see how things unfold over the next month, but rates so far are looking better for this year than they did in 2025. So I'll take the good news. Thanks for listening.
I just wanted to take a few minutes and say thank you for joining us on this month's market report. If Jen or I can help you, we would be glad to. If you're thinking about putting the house on the market this spring, please reach out. We'd love to schedule a consultation with you. If you're thinking about buying, we like to do those consultations as well and make sure everybody's aligned to get you the best deal all the way around. Thanks for joining me.